Not so certain that some of the PMI data that came out of Europe are any worse than the existing production data and what we know about global trade. I think that there's a lot for markets to digest. We had over a 20% rally in equities. The Federal Reserve has changed its policy tactics completely and will in fact buy U.S. Treasuries to replace mortgage bonds for a portion of their portfolio out into the future.
Just to hold the balance sheet steady as they
to do that and to exchange one asset for another.
Right.
And, I've said to a lot of people, never ignore the yield curve. The yield curve is a true leading indicator, but I do want everyone to just take note that if we've marginally improved, we've seen a rally in the U.S. Treasury market because the Fed has taken the warning signs and changed course. I don't think that that's really added significantly to recession risk from where we were before.
Greg, it's an interesting point. If you go back to, you remember better than anyone, the 06-07 example, when there was all of these different theories about why the yield curve was inverting back then and the global savings glut and this and that. And, long story short, should the Fed have stopped hiking sooner?
That's very hard to say because when you go back to 06, 07, what happened was that there was this kind of like fragility in the financial system that we didn't really know about until the financial crisis was well underway. I mean, knock on wood, but I don't think that fragility exists today. So it's not like we're sleepwalking into another cataclysm like that. And I know that you can make an intellectual case why the inverted yield curve shouldn't matter as much as it used to. Central banks have bought all these bonds. I've seen plausible estimates. That's pushed the long end of the curve down as much as 75 basis points. So without that central bank intervention, you wouldn't have an inverted yield curve today. Kelly, I would say, though, that there's a risk of overthinking this. There's nothing magical that happens when the inversion crosses from positive to negative. It's the flattening of the curve that tells you things are getting worse. And the market right now believes the Fed ought to be or will be easing in the next year or two.
Okay.
And that's a pretty striking, turnaround. I mean, they only tightened back in December.
Right.
So that's telling us something, and I don't think it's a positive story.
Greg, let me also ask, because the big news over the weekend, of course, was the Mueller report and the president's reaction to it by saying he's exonerated and now he's heading into these talks with China. The idea is he's going to be strengthened and perhaps take a harder line. What do you think the impact will be if you were to follow that line of reasoning?
Well, it's a little bit tortured, I think. People, I think, are drawing too much of a direct line between some of these domestic events and the larger agenda. There's no question the president wants and needs political wins, and the Mueller report is a political win for him. So insofar as that takes the pressure off him to get a political win on a trade deal with China, maybe he can actually be a little tougher and it gives him a bit of leverage. But I wouldn't push that line of reasoning too far. With respect to China, what he's really worried about is the economy. Will the consequences of a trade war with China hang over the economy and endanger his re-election chances?
Yeah.
Insofar as that risk remains, he very much wants a deal. And the last information we had last week is that he told his trade ambassador, Robert Lighthizer, get a deal.
And so, Steve, that leaves the U.S. economy in what kind of position for growth this year, do you think?
A lot slower than 2018. The absence of tax cuts alone will slow growth. Now, I would say that with the government shutdown ending in January, we probably have seen sort of the weakness front-loaded in the year. We're probably sub 1% on GDP growth, and I do think that we can improve from that. But we should be planning for a much slower growth year in the absence of tax cuts. And what we have seen is outright decline in exports this year already. So I think things like the domestic housing industry, again, which contracted a bit last year, told us that the Fed was off course. So these different policy risks, some coming from abroad, Brexit, et cetera, but the Fed being on the course that it was, it's really important for us to veer away from these risks on the trade front and on monetary policy.
All right.